You're seeing this, right? A stock worth 50 cents suddenly shoots up to over $7 in 3 days. That's a 1,400% gain. Not a typo. 1,400%. But wait, because right now, as you watch this video, that same stock has already lost more than half of those gains. So what the hell is happening with Beyond Meat? And more importantly, is this a sign of an epic recovery or the biggest market trap of 2025? Stay with me until the end, because I'm going to show you exactly what big investors do not want you to know about this explosion and why Wall Street analysts are calling this the perfect storm. Let me tell you a story that sounds like a thriller movie script. October 14th, 2025. Beyond Meat is trading at 50 cents. 50 cents. A company that was once worth $14 billion after its 2019 IPO is now worth less than a Starbucks coffee. October 17th. The stock starts moving, for no apparent reason. October 21st, boom! The stock explodes 600% in 72 hours. Trading volume? 1.2 billion shares in a single day. To put that in perspective, that's 250 times the normal volume. October 22nd, the madness continues. The stock rockets another 90% in pre-market trading, hitting $7.69. October 23rd, reality check. The stock crashes 23% in one day. But what caused this absolute chaos? To understand this roller coaster, we need to go back a few weeks. October 13th, 2025. This was the day Beyond Meat shareholders will never forget. The company announces that 97% of creditors accepted a debt swap. In theory, sounds great, right? The company was drowning in debt, $1.3 billion of total debt against just $103 million in cash. Bankruptcy was a real possibility. But here's the problem. To make this deal, Beyond Meat had to issue 326 million new shares. Let me repeat, 326 million new shares. The company had only 76 million shares before this. Now, over 400 million. This means creditors now control 88% of the company. Former shareholders diluted into oblivion. The result? The stock plummeted 56% in one day, from $2 to 88 cents. The worst day in the company's history since its 2019 IPO. But here's the interesting part. While everyone was running for the exit, some investors were seeing something different. Enter Dmitry Semenikin, a Dubai-based trader known on social media as Capybara Stocks. This guy did something many considered crazy. He bought 4% of all Beyond Meat shares when the price was at rock bottom. And he didn't do it quietly. He went to Reddit, YouTube, and started shouting to everyone that the stock was going to explode. His argument? Simple and powerful. Number one, the debt swap eliminated bankruptcy risk. Number two, the company now had room to breathe. Number three, 63% of shares were sold short. Number four, this was the perfect setup for a short squeeze. For those who don't know, a short squeeze is when investors who bet against a stock by selling shares they don't own are forced to buy them back when the price rises, creating an upward spiral. And Beyond Meat had the perfect ingredients for this. 63% short interest, borrowing costs reaching triple-digit annualized rates, and a small float with few shares available for trading. But the real rocket fuel came from two news items. Catalyst. 1. Monday, October 20th. Beyond Meat is added to the Roundhill Meme Stock ETF, the same fund that holds GameStop and AMC. This sent a clear signal to the entire retail trader army. Hey, this is the next meme stock. Catalyst 2. Tuesday, October 21st. Beyond Meat announces massive expansion at Walmart. Products will be available in 2,000 more stores across the United States, including new value packs. Sounds good, right? A real positive operational news. But here's the truth nobody's talking about. This Walmart news changed nothing in the company's fundamentals. Beyond Meat is still losing money, still has declining sales, still has tight margins. But for momentum traders, it didn't matter. They saw meme stock ETF check, short squeeze potential check. Positive news as an excuse check. Volume exploding check. It was time to buy. And then the show began. Day 17, plus 100%. Day 20, plus 200%. Day 21, an additional plus 300%. The shorts were being squeezed. With 39.59 million shares sold short, the bears were in total panic. Options activity spiked 15 times normal volume. 74% were call options, bullish bets. Everyone wanted a piece of the action. Trading volume? Absurd. 1.2 billion shares traded on October 21st. For context, average daily volume was 5 million shares. That's a 24,000% increase. Social media went into a frenzy. Reddit, Twitter, Discord, everywhere you looked. BYND to the moon. Traders who bought at 50 cents were seeing their positions multiply by 15 in a matter of days. It seemed like easy money. It seemed like Beyond Meat had finally turned things around. But there was a problem. The company's fundamentals were terrible. And I'm not exaggerating. Let me show you the real numbers from Q2 2025. Revenue, $75 million, a drop of 20% year over year. Gross margin, 11.5%, down from 14.7% the previous year. Net loss, $29.2 million. Adjusted EBITDA, negative $22.1 million. The company was burning money like there was no tomorrow. And it gets worse. Beyond Meat had to lay off 6% of its workforce. Withdrew guidance for the full year, a classic sign things are bad. Completely exited the Chinese market. Sales fell from $465 million in 2021 to $326 million in 2024. The plant-based meat category as a whole is in decline both in U.S. retail and international food service. And Wall Street? Analysts aren't buying this story. Of the 8 firms still covering the stock, 5 have sell or strong sell ratings. The median price target is $2.27. That's 37% below the closing price of $3.62 on the 21st. One analyst even lowered the price target from $2 to $1.50, saying, equity dilution and market challenges justify the sell rating. So the question is, how did a stock with such bad fundamentals manage to rise 400% in 1 week? And more importantly, what happens now to those who bought at the top? Let's break down the exact mechanics of what happened here, because understanding this can make you money or save you from losing a lot in the future. Phase 1. The trap is set early October 2025. 39.59 million shares sold short. 63.13% of the float was short. A 26.65% increase in short interest in just 1 month. The bears were convinced Beyond Meat was going to zero, and they had good reasons. Bankruptcy was a real possibility. Phase 2. Borrowing costs. Explode when you short a stock. You need to borrow those shares from someone, and that loan has a cost. In mid-October, the annual cost of borrowing BYND shares reached triple-digit rates. That means maintaining a short position was costing over 100% per year. For the shorts, every passing day was burning money. Phase 3. The initial spark. October 17th, the price starts rising for no apparent reason. From 50 cents to 75 cents, then to $1. The first shorts start feeling pain. Some decide to close positions, which means buying the shares back. But here's the problem. With such a tight float and so much short interest, every purchase pushes the price even higher. Phase 4. The death spiral for shorts. Price goes up, shorts lose money, some close positions by buying. This pushes the price higher, more shorts suffer, more closures, price rises more. It's a self-feeding cascade. And when retail traders saw what was happening, game over. Everyone wanted in. Here's something few traditional analysts understand. The power of social media in 2025 is scary. October 14th, a Reddit user posts, "It's time to make $BYND great again. This stock deserves a squeeze." October 18th, Eric Jackson, known for his meme stock campaigns, posts on X. I'm being flooded by people wanting me to take a position in BYND. October 20th, Dmitry Semenikin announces he bought 4% of the company. His YouTube videos start going viral. October 21st, the hashtag BYND is trending. Dozens of finfluencers making analysis videos. Beyond Meat's ticker becomes the most active on the Yahoo Finance platform. And here's the naked truth. For every person who made money promoting BYND early, there were hundreds trying to get in later, and those people got massacred. Because here's what nobody tells you about meme stocks. When you see the opportunity on social media, it's usually too late. The early buyers, they got in between 50 cents and $1, multiplied their money by 7 to 14 times. But most people, they saw the viral videos when the stock was already at $3, $4, $5, and then they bought at the top. October 22nd, Wednesday. The stock opens up, shoots to $7.69 in the first hour of trading, gains of up to 133% in pre-market. Everyone thinking it was going to $10, $15, $20. And then, gravity returned. The stock started falling, gave back all the day's gains, fell as much as 27% before partially recovering to close practically flat. October 23rd, Thursday, down 14.5%. October 24th, Friday, more declines. In less than 72 hours after the peak, the stock had lost over 60% of its value. Who bought at the top at $7? Watch their investment melt to less than $3 in a matter of days. What happened? Simple. Number 1. The squeeze was over. The shorts that could close had already closed. There was no more fuel. Number 2. Profit-taking. Early buyers started selling, and when there are more sellers than buyers. Number 3. Reality check. Investors finally looked at the fundamentals and realized nothing had changed. The company is still bad. Number 4. Lack of catalysts. There was no more news to sustain the momentum. And now comes the question everyone's asking. Who profited and who lost? The winners. The early sharks. Dmitry Semenikin and other insiders who bought below $1. If he held 4% and sold at the peak, estimated profit, millions. But most sold well before the top. Professional day traders, traders with experience in short squeezes, got in on the momentum, placed tight stops, took quick 20 to 50% gains, and exited. The creditors. The biggest winners? The bondholders who accepted the debt swap. They converted worthless debt into 88% of a company that suddenly was worth $1.4 billion. Even with the drop, they're still hugely profitable. The losers. The FOMOs, fear of missing out, bought above $4 to $5, didn't set stop losses, still holding, praying for a miracle, losses of 50 to 70%. The stubborn shorts, maintained positions even during the squeeze, paid fortunes in borrowing costs. Some eventually profited on the way down, but many went broke before. The Reddit hold the line crowd believed in the diamond hands narrative, refused to sell thinking it would go to $50. Now, underwater and bitter. If you want to survive and prosper in situations like this, memorize these lessons. Lesson 1. Fundamentals always matter, eventually. Yes, the stock multiplied by 14, but it was unsustainable because the company remains terrible. Revenue falling 20% year over year, negative margins, burning cash. No squeeze changes that. Gravity always returns. The question is, will you be on the right side when it does? Lesson 2. When you see the opportunity, it's too late. If it's viral on TikTok, YouTube, Reddit, the early birds have already eaten. Videos saying, "Buy now," usually appear when the creators already got in much earlier and are preparing their exit. You're not discovering an opportunity. You're being the liquidity for those who discovered it. Lesson 3. Volume and timing are everything. Watch the patterns. Volume 250 times above average, red flag of unsustainability. Huge gaps upward, usually followed by gaps downward. When options spike 15 times normal volume, the end is near. Lesson 4. Have an exit plan before entering. Winners had stops. Losers had hope. If you enter any speculative trade without knowing exactly when you'll exit, both in profit and loss, you've already lost. Lesson 5. Meme stocks are casinos, not investments. There's nothing wrong with making speculative trades, but never confuse this with long-term investing. If you bought BYND expecting to hold it for years, you didn't understand the game. So, what happens now with Beyond Meat? Let's look at the facts. Bear scenario. The debt swap only bought time, didn't solve the fundamental problem. The plant-based category is in decline, not growth. Fierce competition from impossible foods and private labels. Cash burn continues. Analysts with price targets of $1.50 to $2.27. Probability of long-term success? Low. The company may end up being sold for parts, acquired for pennies, or simply disappear in a few years. Bull scenario. The debt swap eliminated immediate bankruptcy risk. Walmart expansion could generate incremental revenue. With leaner costs from layoffs, it might get closer to break-even. If it can stabilize the business, it could be an acquisition target for a larger player. Probability? Possible, but unlikely. Realistic scenario. Beyond Meat will probably continue existing at a smaller size. Focus on specific niches like business-to-business fast food. Have more temporary speculative rallies. Eventually be sold or do another debt swap in 2 to 3 years. The stock will continue being a volatile penny stock, a playground for traders and speculators. And here's the crucial warning. The company has a special shareholder meeting scheduled for November 19th. On the agenda, increase authorized shares from 500 million to 3 billion. Approve new equity incentive plan. Potential reverse split. Translation? More dilution may be coming. So here's the truth about BYND. Was it an epic short squeeze? Yes. Did some people get rich? Absolutely. Did most people lose money? Definitely. The lesson isn't never trade meme stocks. The lesson is understand the game you're playing. If you want to make speculative trades, enter early before it goes viral. Small position size, always have stops. Exit with profit before the top. Don't fall in love with the narrative. If you want to invest, completely ignore this type of situation. Focus on companies with solid fundamentals. Think in years, not days. Will Beyond Meat have another rally? Maybe. Probably will. But the question isn't if it will happen, it's whether you'll be prepared this time. The market is full of opportunities, but it's also full of traps. The difference between winning and losing isn't luck. It's preparation. Trade with wisdom, not emotion. Don't just watch, think. Subscribe to ChremaDynamics and question everything that moves our world.